All right. Hello, ladies and gentlemen. Welcome to another episode of our Property and Finance podcast. Today, we have a bit of a different guest to our typical guests that we bring onto our Property and Finance podcast. Today, we have an internal staff member, Roland Xu. Welcome aboard.
Thank you for having me.
So Roland is one of our financial planners, and I thought it would be good to mix up our usual content of getting various guest speakers in and actually get someone from the team to talk about something that we feel is a growing lack of understanding, almost, being financial planning and insurance and the whole advice piece. It's something that consumers are becoming more aware of needing, just because the industry itself got somewhat wiped out the last 10 years. It drastically shrunk because of regulation and the red tape. And now it's coming back because, I think the people in the right places are realizing that consumers need this service and need this advice. And we as a business are also feeling the same, that our clients need this service and need this advice. And we've had a financial planning business for a little over 9 years now, but now we're focusing on growing that offering. And who better to come on the podcast and talk exactly about that? So, Roland, thank you for joining us.
No, thanks for having me.
So I should start by giving a bit of background about Roland. So Roland's been a financial planner for, a little under a decade?
Yes, just a little, 7 years now, yeah.
So why don't you tell us a bit about yourself and, but essentially the role of a financial planner?
Yeah. Well, I think most people traditionally think financial advisors or financial planners work with a lot of retirees. So people who are,
Definitely the case.
Yeah. 50, 60 plus. But I actually think we're seeing more and more sort of younger people actually reach out and look for that financial advice now. So a lot of people who, in their 30s or have really high earning potential are actually going, well, what should I be doing with my money, or how can I be growing that in sort of the right ways? That's what I work with a lot of is the holistic advice space. So with a lot of sort of younger accumulators who are in the space of, well, how do they structure their finances? Should they be owning properties personally? Should they be owning it inside super or within trusts? Should they be investing in shares, or should they be putting in a super? Like, these are all questions that a lot of people have, and that's really what I'm here to answer and sort of help people work through a really clear strategy.
So let's call that out, because you said the word there, but I don't think people understand too much. So that's a cliche client of yours, being an accumulator.
Yeah.
Young family or young individual with decent income, normally have bought a house, got themselves in significant debt to buy the house in Australia. And maybe it's dual income with combined significant debt, and now they're looking at wealth creation strategies.
Exactly that. Yeah. So it's I think a lot of clients will sort of come to me going, well, I don't have millions of dollars to manage, and I go, well, that's not the point of what a holistic advisor does. Those people are talking to really high net worth investment advisors. What I work with is every sort of just normal people.
Sorry, go on.
Yeah, just people who have, like, as you mentioned, the mortgage. They have potentially one property that they're invested in, or they have some shares. They got their super, and really just, well, what are we doing to make sure that your wealth accumulates enough?
And I guess then going to the flip side of what you started that point with, still the wealthy retirees are a great client to have, and they're the individuals that definitely need financial planning, but you don't necessarily need millions in super to justify that. A lot of people are sitting on a lot of equity in their home, a lot of downsizers and potential retirees. And they don't realise there's an opportunity to create a retirement strategy or plan with that equity, right?
Yeah, exactly that.
So maybe talk to the other type of client in that sector.
Yeah. So, we do get lots of different clients, and a big part of them might potentially have a really high value property, right? If you bought a property in Sydney, well, years ago, and then you've done nothing, it's probably grown like so much in terms of value. And some people don't realize this, but using that equity, that is another source of creation that they can have. And that doesn't mean, selling the property on any downside necessarily. But even if you say, have like a $3 million property, that means you can borrow up to a little bit more, and you can be using those funds to, invest into shares, or you can be using that to invest in a property. Now, just caveating, obviously, this is general advice. So,
We'll do the disclaimer.
Speak to an advisor about this, but there are lots of different strategies where we can utilize that equity or utilize that income to make it work a little bit harder, so that by the time you get to retirement, you are in a much stronger financial position.
Well, I've seen, and general advice and just case studies, and we might have to cut this part, who knows, but I've seen a lot of interesting situations actually with some sort of wealthy baby boomers that have significant equity where, let's just say they've got a primary residence that's completely unencumbered, and that primary residence might be of substantial value. And I've seen them engage in either with a financial planner or wealth management organisations that put a first mortgage in place against the property and use that entire first mortgage, the funds from the loan, so just a regular mortgage, to then invest in something that's much higher yielding than the cost of that first mortgage. And that arbitrage might be 5%.
Yeah.
So if they go do that with, a couple $1 million, they've just created $100,000 or so in income.
Yeah, that's right.
So that's quite common these days, is it not?
Yeah, well, definitely one of the strategies is, and just caveating again, there's obviously risks associated with investing in these high yielding assets. It's not always super rosy on that end, but
some of them are fixed income funds.
Yeah. Yeah. Well, I mean, fixed incomes obviously have their own sort of set of risks as well. There's default risk, there's credit risk, there's duration risk. So they sort of have their own set of risks there. But in theory, the idea is, the income that you do derive from that, if it's more than the cost, well, you've created an additional source of income for yourself. And that's really useful for retirees in particular who might not have necessarily a job, and what they're looking for is a bit of cash flow. They don't necessarily want to be putting everything out of pocket for the mortgage repayments. That can be a really effective strategy too.
You can hopefully see the differences in me being the qualified mortgage broker and you being the qualified financial planner in making sure people understand the risk and your point to it.
Yeah.
But no, it's rightly called out. A lot of people have moved into, let's say, the private credit space, being the private lending, investing in private lending, and they don't quite realise there is risk associated with that.
Absolutely.
And significant risk.
Yeah.
If you're chasing sometimes 10% return or 10% interest, it's all well and good until all of a sudden
it's not.
Some of your capital is not being repaid.
Yeah, exactly.
So good call out there. So let's break it down. So they're the type of clients. You've got the retirees, potential retirees, downsizers that have various things that they might not be privy to utilising, like the downsizer contribution and whatnot.
Yeah.
Then you've also got the accumulators, which I think is a growing sector. It's a growing
absolutely
form of clientele that are becoming a bit more aware that they could engage a financial planner. I think we should also call out that some people don't, in the accumulator stage, because we deal with a lot of inquiry in the business, a lot of people think it's just about finding the leaky bucket as such in their cash flow, and that you're going to reinvent the wheel and potentially say, wow, I just could save you $1,000 a month just by cutting out X, Y, Z. That's not really the role of a financial planner. Yeah. It's not just about budgeting and cash flow. It's about a strategy and strategic advice, right?
Absolutely. Yeah. Look, and to that point, the cash flow piece is one of the most important, and it is definitely my starting point for my discussions with every client. But that's definitely not the last and final piece.
Yeah.
It's about, well, if we do plug the leaky bucket and we save $2,000 a month here, what are we doing with that money, and how are we making sure that it is working for them?
Yeah. I guess the number one theme of the conversation is about investing.
Yes.
Right?
Yeah.
So we should caveat the conversation with you wanting to invest money.
Yes.
Because I do feel that people reach out to a financial planner looking for some sort of hidden secret, and they're not actually willing to invest. So on that note, let's talk about some of those investment strategies or options or products as such. So.
Yeah.
The big one, obviously, that's the no-brainer for a financial planner or advisor to add value with the client is obviously superannuation. A lot of superannuation funds are somewhat underperforming.
Yeah.
I feel like I get in trouble whenever I say that, but I will say it again because
general
advice. But you can hop on Google and have a read yourself on all the articles of a lack of performance in the average retail super fund. I think if you even ask Gemini or ChatGPT for the historical performance for the last decade or 30 years of the average retail super fund, it's 7 or 8% total return, including distribution.
Yeah.
which isn't that attractive.
Yeah, it does depend a lot on what you are invested inside super, and this sort of stems to the point that look, the reality is most people don't even check the super.
No.
Like if I asked my average client, what is your super invested in, they go, I don't know, wasn't there only one option to be invested in? And even inside your industry super fund or a retail super fund, there are so many different options out there. You got to know what that's invested in first, and that's really a discussion point.
And that's exactly all it is, a discussion point where maybe you're willing to have exposure with overseas equities and overseas shares. Maybe you're willing to take a long-term approach and putting some form of leverage in an ETF or whatnot. The risks associated.
Yeah.
But I think that's to your point. These industry super funds and some of the default products that people get put in are very low risk, meaning low return. And they should understand their options.
Yeah, I mean, I wouldn't necessarily even say it's low risks. It's almost a different set of risks. Like when we talk about risks in general, we refer to volatility or what the price is going to look like, and or how that's going to change. But like industry super funds have their own set of risks as well. I think a large amount of these large funds that people invest into, they do have a lot of private holdings and assets that you can't even necessarily see or you don't have visibility over, and those aren't always valued very frequently as something that you might see on like the stock exchange where it's getting valued very, very frequently. So it's really about understanding what your super is invested in, and that's the first discussion point. Is it invested essentially in those right things? Is it invested in line with what you want to be invested in as well? And if not, then that's a discussion of, well, should we be changing that as well?
So should we talk about fees then on those funds, which is a point of difference, I guess, with the financial planner? Sometimes the fees that these super funds might charge are probably in line or less than what you would charge for actually giving personal advice.
Yeah, that's right. Like a lot of these super funds, they sort of charge percentage-based fees, and so a lot of people don't really notice when the fees do start stacking up. We're talking even 1% of a balance of 200,000 portfolio is $2,000 a year, which is quite significant.
Yeah, and it's almost $200 a month.
Exactly. Yeah, and for most people, they don't notice it because again they don't check the super balances.
Well, also the way I've noticed that they charge those fees is a little bit strategic in the sense that they sometimes take it out of the unit price,
yes.
right?
Yeah.
So you don't actually notice it because it's not really appearing on a statement as a annual management fee or whatnot.
Correct. Yeah. So essentially it's deducted sometimes from the investment performance, and sometimes you see that's why investment performance is not necessarily the nominal figure that you see there is not reflective of what your super has actually done. And so, like to that point exactly, a lot of the time the fees really do stack up, and you got to know what questions to ask and how to ask those questions to actually get that from your super fund.
Yeah, so we won't bag the super fund too much more because I don't want them to come knocking on our door complaining. So fees are about potentially if they're charging 1%, on a substantial balance, it could be actually cheaper to speak to you to get ongoing advice and something a bit more tailored to their long-term objectives.
Potentially.
If someone had a few $100,000, for example, in superannuation, you could break it up into several different funds if they wanted, not just be all in the one, which most people have when it's their own sort of superannuation.
Yeah.
And sometimes it's also not necessary to set up an SMSF to do so, right?
Correct.
They could just speak to you, and you can manage it in your platform without having to go through the process of setting up an SMSF.
Yeah, absolutely.
That's a great probably segue to SMSFs. Why would someone set up an SMSF?
For most people who are sort of in that accumulator stage with self-managed super funds, one of the advantages and what you can really leverage is you have a lot of flexibility in essentially the assets that you can purchase inside that fund. And on top of that, you have the capability to actually borrow fund inside a self-managed super fund. So for most people, what that means is if they wanted to buy direct property, then they can actually borrow funds from lenders to acquire a property inside a self-managed super fund, which is, you do need a self-managed super fund to do that. There's no other super product essentially that would allow for that. You would need to set up a completely separate entity to make.
So that's the most common reason to buy property, and we're seeing a growing. Once again, there's data on this. A growing amount of people setting up SMSFs the last 5 years. I think because of all the articles about the lack of performance from retail super funds. And the power of leverage sometimes can drastically outweigh, even if you might get 10% as opposed to the 7 or 8 average. as in 10% on your superannuation performance, if you put that $200,000-300,000 into let's say a $900,000, $1 million property, the power of leverage really can outperform sometimes that individual fund performance. But once again, general advice.
General advice. And that's an excellent point, because a lot of people might sort of see the nominal or the headline rate and they go, well, shares in theory should be able to outperform property if you're comparing a like-for-like basis. But in reality, in Australia, it is hard to get funding if you want to borrow funds to buy shares, or you want to borrow funds to buy into different funds. It's not quite as easy as you go into the bank and say, I want to borrow X dollars to buy an investment property. They're a lot happier to lend that.
But there are ways, to access debt in equities, and I think from my personal experience, the best way is these, geared ETFs. We've had the chief economist of Beta Shares on here in the past multiple times, and Beta Shares have some great leveraged ETFs, both locally and US. So there is forms of gearing,
yes,
but not at let's say typically most people in their SMSF would purchase something at around 80% on a residential LVR.
Yeah.
That's not the case with equities.
No, you would not want such like high leverage when it comes to equities, just given the volatility that is associated.
Yeah.
Those have sort of their own mandates, and the last thing you want is for them to have a bit of a crash and then have to sell their whole portfolio.
Yeah.
That's a risk that I don't think Beta Shares would frankly take on.
No. So on the property front, let's just call out that debt process. So you still obviously give advice for people that are looking at a long-term, mixed strategy of property and equities?
Yeah, absolutely. So a lot of the time, for most clients, I wouldn't suggest you go one way or another. So a lot of people might sort of come to me and go, they only have cash to invest, or enough cash to sort of buy one property inside the self-managed super fund. And I would caveat that if you already have multiple properties in your personal name and you got your own property that you're living in, diversify. Yeah, exactly that. We don't want everything tied up inside one investment asset, and we don't want to be over leveraged, which is again a really important discussion point.
And I think it's also important to highlight, going back to the role of a financial planner, that a financial planner should never recommend someone buy a particular property.
Yes, correct. Yes.
And there's a bit of that that's happened historically, and that's something that you won't do, and none of our team here at Shaw Financial do. It's not up to the financial planner, or it shouldn't be the role of a financial planner to give advice on a particular property and whether they should purchase it or not. All a financial planner can or should do is just model how that looks.
Exactly.
So if a client has found a property and is getting 4% yield, and they're going to put down a 30% deposit, and they're going to borrow the money at 6%, just model how that looks over a 5-10 year journey or investment strategy. That is a part of your sort of job description, not the form of being direct advice on a particular asset, which I've seen a lot of clients be told to buy brand new properties by financial planners, and that is actually the reason of some of the red tape and heavy regulation that we saw in the last decade, because people were being pushed into brand new stock because they're getting incentives from the developer.
Yeah, exactly.
So some of that regulation was warranted. But yeah, I guess going back to the property process, as the mortgage broker out of the two of us, calling out that borrowing money in super has become a lot easier. And there's a lot of lenders out there that now will offer SMSF lending solutions.
Yeah.
If a typical client goes and speaks to a major bank or a second tier lender, most of the second tier lenders at least, they'll probably say that you can't borrow money in SMSFs anymore. And that's because the major banks pulled out of it.
Years ago.
In the residential space, at least. There's still some floating around in the commercial space, as in, residual debt. But yeah, it's not the case that it doesn't exist. There's now specialist lenders that have that as one of their core products. And you can also use things like future contributions to make servicing work. So what I mean by that is a lot of people, wake up one day and they go, wow, I've got 250 grand in super. I could go buy $1 million property.
Yeah.
But they've only been contributing, let's say, 5 or 10 grand a year to their super to get it to that level. If all of a sudden you want to buy a property and you're willing to increase your contributions, the bank will recognize those increased contributions moving forward into servicing, which makes a big difference.
Yeah, and exactly. Well, that's what I would work with through my clients as well is, well, what is the amount of contributions that we should be looking at that is, reasonable in terms of cash flow and reasonable in terms of the deductions that you'd be deriving from those contributions. A lot of the time people don't realize this, but before you step in all of that, you really should be modeling what is your cash flow going to be. I've clients who sometimes go, I want that property inside the SMSF, and then they look to borrow 800,000, but one of them might be on maternity leave for 2 years after that. What is going to happen to those repayments in that time? You need to look at your cash flow in the future. You need to go, let's say the worst happens and this property, is unrented for like 2 or 3 months, or, something comes up and we've got to pay the expenses. Do we have enough to actually make this work? These are all sort of discussion points. Yeah.
And I guess going back to, once again, I keep saying this, the role of a financial planner, but understanding those various concessional contribution and non-concessional contribution options, and modeling an investment strategy on someone's cash flow, that's something that, once again, people aren't really getting enough advice on, because people start looking at investing, and they once they've got some spare cash flow, let's say, they start typically investing personally, where there could be better ways to do that.
Absolutely.
If you're in the top income tax bracket and you're not meeting the concessional contribution cap per annum as an individual or as a couple, then you're leaving
so much on the
much on the table. There's an opportunity there that you can the government essentially could thereabouts match you dollar for dollar on your investment strategy. On a top income tax bracket individual. So that's a big part of your value add and service offering, right?
Absolutely. Yeah. I mean, to that point, like sometimes I see clients who are on that 40% marginal tax rate, the highest tax rate, and they don't know, well, the super is being taxed at 15%. So each dollar that they're putting in, well, that's 32 cents they're saving, and that's really, really big. If they manage to put $10,000 in there, that's the massive saving that they're getting in that 1 year already. And again, going back to advice fees, if people don't realize this, that's more than enough to pay for the advice fee just from that one simple contribution strategy.
Exactly. So let's just call that out actually in a bit more detail. So, someone earning, let's say, $250,000 a year, they're well and truly above the top tax bracket. If they, I think the cap now has increased back to 30,000. So if they were contributing, $15,000 a year, and then they increase it to 30, essentially they're reducing their $250,000 income down to $220,000, and they're getting the 47 cents thereabouts, or is it 48?
32% saving essentially on that. So
once you take the 15% off,
exactly,
because you get taxed 15% on the way in, so it's a 32% saving. Basically, the government is contributing 32% towards your super on your contributions.
Yeah, exactly. Yeah, it's massive. If you're not thinking, or you're not doing that at that point, it's really, well, why would you be investing those funds personally?
Yeah, why would you be doing it personally? And then let's talk about what that long-term means in your super. So if you've got a few $100,000 in super earning, call it 10% per annum, that's $30,000 a year. You're only paying 15% income tax on that before retirement.
Yeah.
And then after retirement, it's essentially tax-free?
Well, yes and no. So for most people, we have what we call essentially the preservation age. So for most people nowadays, the preservation age is age 60. So if you are retired at age 60, what that essentially means is you actually can change all the amounts that you have in accumulation into what they call like an account-based pension, and that turns fully tax-free at that point. So all those capital gains that you've built up, over the last 40 years or whatever it is that you've been working, all of that essentially gets wiped, and you have no tax liability.
So hopefully, I think we've got some compounding calculators or calculations that we had in our newsletter in the past. You should hopefully turn that $300,000 today into millions by retirement is the aim. If it doubles every, let's say, 7 years, the compounding effect over 20, 30 years, you should have a substantial amount to retire. And then that substantial amount, let's say you turn into $2 or $3 million, at 10%, there's $200,000 to $300,000 that could be tax-free income.
That's right. Yeah.
So if you're investing in your personal name, it's a different story.
A completely different story. By the time you need to retire and sell those shares, that's going to attract a really big capital gains tax liability. Assuming again, it's compounded and done really well over all those years. You don't have that, tax burden at all if it's inside your super and you're retired at that point.
So let's call out also that a theory or a concern that people have about, putting money in super. Obviously, there's the natural, obvious one that you put it in super and you can't touch it till you're 60.
Correct.
But you get benefits for making that sacrifice.
Yeah.
The other one that's definitely been a bit more apparent as of late, especially the last 12 months, is, the exposure to, legislation changes and tax changes on funds in super.
Yeah.
And we saw this year that, there was the discussion of taxing unrealised gains
Div
over
296.
Div 296, was it?
Yeah.
And then that was over a certain threshold, and then over a certain threshold also higher tax. And we did see some of those changes come into place, and not the tax on unrealised gains, but the higher income tax above 3 and 9 million, was it? Balances?
Yeah, that's right.
A few call outs on that. A lot of people think, okay, now you're paying, if you've got a balance of $3-4 million, you're paying a flat 30% across the portfolio. No, it's tiered just like your income.
Yeah, exactly.
And they break down the overall balance and prorata it. So you're still way ahead, even with $3 or $4 million in super.
Yes, absolutely.
You're still only paying 15% on the majority of it.
Yes, yeah. So I think, again, the way that it's presented can be a little bit misleading. Like, just with marginal tax rates, I think some people think all of their income is taxed at that rate, and that's obviously not the case. It is marginal in that, for each additional dollar that will be taxed at that rate. So it's only the amount above that $3 million that would incur that higher tax rate as well.
So my call out with all that is that, yes, there is exposure to potential legislation changes around tax laws in super. However, correct me if I'm wrong, the federal government is always going to have an incentive to make sure it's attractive for people to put money in super.
Absolutely. And I think they actually came out with the data on this, and I don't recall off the top of my head, but the amount of people which are actually affected by this, in terms of the amount of people affected by Dividend 296, is quite small.
Yeah.
As a percentage of the population, it's not a large amount.
I think it was like 4% or something.
Yeah. It was a really, really, I suppose in the general scheme of the population, a pretty insignificant amount. And so I know a lot of people were quite upset about these changes, but ultimately, for most people, it's not necessarily going to affect them, and especially since they've said they're going to be indexing that.
Yeah. So I was just about to say, sure, it only affected a certain amount of people at the present time, but when they said they weren't going to be indexing, indexing meaning increasing those caps over time with inflation. Originally, they were proposing that it's just a fixed $3 million, irrespective of inflation and wage growth or anything like that. Now they have agreed to index it, so that $3 million will increase over time. But yeah, I guess to call out, people that get concerned that, don't put money in super because, one day the government could change laws and it's not going to be that beneficial to have money in super. It's always got to make sense that the money in super is advantageous.
Correct.
So that people are encouraged to put money in super.
Absolutely. The government has all of the incentive to want you to plan for your own retirement, which is why the superannuation system is set up as it is. I think another one that I actually hear a lot from clients is they're worried about them essentially changing when they can access the super as well. And that's something you hear for a lot of the younger population. They go, well, the retirement age has shifted and now it's 67 instead of, years ago where it's like 65. And then they're like, well, what happens next? Are they going to increase it to 70? That is separate to the preservation age. And I think people need to remember that,
Great call. I was just about to say, can you touch on both those points?
Yeah. So actually, one of the things that you would have seen is preservation age is essentially when your super becomes unrestricted, and for most people born after a certain year, that is age 60 at the moment. Previously, the preservation age was 55, and so for people born before certain years, they can still access the super at age 55. They never delayed your access to super. What they've done is essentially just shift the statutory retirement age, which affects things like Centrelink age pension, and more so towards that aspect rather than when you can actually access your super. So for most people, what I expect the government to do is, even if they do change the retirement age, it's going to have no effect on your preservation age. And even if they change the preservation age, they're going to grandfather that rule so that people born from this year to this year are still going to have access to that at age 60.
So, but can you call out the big difference between the preservation age and the retirement age?
Yes. So the preservation age for most people, that's age 60, and that's when you can change all of your super into an account-based pension, and you can actually start to take out and withdraw as much as you want. But the retirement age, or the statutory retirement age, is when people essentially become eligible for Centrelink benefits, like age pension or some other other benefits that are associated with Centrelink. And those are two very different entities. That's age 67.
So at the age of 60, you can start accessing your SMSF if you had one, for example.
Correct.
Even if you're working?
It has some more conditions around that. So to access it at age 60, you need to cease a gainful employment. Ceasing a gainful employment could be retiring. That's obviously, no longer working. That's one option. Or it could mean, essentially looking to quit your existing job. And so once you quit that existing job, you can access your super. And sometimes what my clients do, or some other people, just because they don't know whether they're going to go back to work, it's not necessarily saying that you can't go back to work. So you could, quit your role in your current capacity. But then in 2 years' time, you decide, what, I really enjoyed my work, which some people do, right? And so they go back to it. That's absolutely fine as well. They can still have access to all of their super at that point.
Because that's actually there was a lot of articles recently on the news about this. That a lot of people go into retirement and then they realise they actually want to go back to work.
Yeah.
They get a bit bored.
Yeah, that's right.
We live in a society where work becomes, 70% of your week.
Yeah.
and by the time you're 60 years old, you've been doing it for maybe 40 years. And all of a sudden,
that's where they find the meaning, right?
Yeah, 70% of my life is disappearing. So yeah. Hopefully, people don't all feel like that. But I guess going back to the point, accessing at 60 or the 67, the other early access option or ability, I believe, is if you can't work for health reasons and whatnot, right?
Yeah. So if you essentially meet what the Superannuation Act deems as certain conditions, then you can also potentially access your super early as well. And some of these might be like financial hardships. That could be reasons that you access it, or essentially, you're no longer able to work in the future. These are certain conditions inside there that you could access your super earlier too.
Yeah, I've seen the financial hardships as well that people have accessed it under those circumstances.
Yeah.
Okay. Well, that's a great call out. The other thing on the income, I guess, talking about, we've talked the income tax on assets in super, but we haven't talked about capital gains tax on income in super, which is another form of income, really, capital gains.
It is.
So before retirement age, I believe it's 10%.
Yeah, for most people who have things like self-managed super fund, that's where it starts to make a difference. The reality is, if you're in a pooled industry super fund, you probably would never notice a difference. You won't even know what your super tax rate is, because they essentially don't separate that capital and income account to you, and they're reporting to you. But once you start having your own assets in something like a self-managed super fund, then it does make a difference. And the capital gains discount inside super is actually only 33%, whereas in your personal name, that's 50%.
But it's 15% being discounted at 33, which equals the 10, right?
Exactly that. So you do get a discount. It's not quite as much as it is personally, but obviously 10% as a tax rate is still significantly more attractive than what you would be getting in your personal names.
Which is probably 24% with the discount. So to call out the discount, because a lot of people don't realise how the discount works in capital gains, you get a 50% discount of the gain after 12 months if you held the asset for more than 12 months. And this is not just relevant for property, but shares and all forms of assets.
Exactly.
A lot of people buy and sell shares sometimes within 12 months. And if you do that, you're paying the full income tax on it. So if that's in your personal name, it could be the 47%. If it's in your super, it's 15. But if you waited 12 months, it's 10. So that's definitely one big benefit of setting up an SMSF and managing yourself and making these decisions without an active fund manager making these decisions on your behalf. The other one is post-retirement, obviously tax-free.
Yeah.
So if you did buy a property or you did hang on to, let's say, Commonwealth Bank shares that went from $10 to $180, that gain is entirely tax-free.
Yeah, absolutely. So as I sort of said before, if you bought in early to some of these and you just held on to it for all these years, your capital gains is non-existent by the time you sort of turn it into an account-based pension.
I'm going to do the cliche and go back to, let's talk about the role of the financial planner a bit more. So that's I guess investment advice, superannuation, which all those investment strategies in terms of ETFs, active funds, property. That could also be done outside of super. It doesn't need to be in super. You can be looking at setting up trusts. So if you and your partner earn a significant amount of money, let's say between the two of you, you earn over $400,000 or $500,000 combined. That's a definite candidate or situation or scenario where you should be speaking to a financial planner. That's for sure, because you can look at strategic ways to invest using that income. Especially if one of you is self-employed, you can be putting some of that income into a bucket company or a trust and investing with just profits that are taxed at company tax rates, which is essentially a similar net outcome as using a superannuation somewhat.
Yeah, it is. And to caveat that as well, with bucket companies and trusts, they work really well in particular for self-employed people, as you sort of mentioned already. But you have flexibility on how to distribute that, and one of those beneficiaries could be a bucket company, which, like, the gist of it is, well, that essentially caps that tax rate that we talked about, that 47%. You're not going to be taxed at that in the future. It will be taxed at 30% for any investment income that you have there, which is the passive tax rate for a company. So it can be really tax effective, especially for those higher income earners who are sort of, let's say, if you're both in the 47% marginal tax rate, or if you are self-employed, you get a lot of tax savings by running this through, let's say, a bucket company and investing all of your assets through there, as opposed to, again, in your personal names where you are going to be hit with a massive tax bill.
So let's talk about that in a bit more detail. General advice, of course, where if you're self-employed, you, instead of paying it to yourself, you put it into a investment vehicle, which could be a company. Ideally, it's a corporate trustee, I believe.
Yes.
So you get the discount. What I mean by that is that if you invest in a company and there's a capital gain, companies don't get the discount, where trusts and corporate trustees do get the discount.
Yeah.
So if you invest in a company, you're basically paying full income tax on the gain. So you could siphon money from your business into a corporate trustee, buy shares and assets in there, and hang on to it long term, and you're only paying 30% on the way into that, and then on the way out, you're still getting the benefit of a capital gains tax discount. If you want to keep the money invested, then you can set up a separate company where you do intercompany lending and whatnot.
Yeah. Well, actually, to that point, you mentioned 30% for operating businesses. A lot of the time, you actually get a bit of a tax discount as well. A lot of the time, for most sort of smaller businesses, that tax rate's actually 25%. So what that means is you almost don't have to pay tax necessarily above 25% sometimes. If your company, earns those profits, it gets taxed inside your company, and you actually distribute it out through that trust that we talked about, or through that corporate trustee. Yeah, that's a really, really big tax saving that we can actually achieve for a lot of our self-employed clients.
It's funny. I've learned a few of these things over the years, and I just wish I learned them at a younger age. They're such crucial things to know. And, if you get the right advice at the right age, the compounding and accumulative effect of that advice and what it can do to your retirement is huge. Especially, I keep calling it out, if you're earning a significant income, the actual sacrifice of your income compared to the outcome, if you wanted to invest in either a trust or super, it's chalk and cheese, right?
Really is.
The outcome from a small contribution on a monthly basis. And so, on that note, a small contribution on a monthly basis, this whole dollar cost averaging theory that people are seeing on a regular basis these days. Maybe it depends on your algorithm, but I feel like there's all these TikTok influencers and whatnot talking about investment strategies and how you can salary sacrifice a part of your income that convert straight away into purchase equities on a monthly basis. Run me through a bit about how that works.
Yeah, I mean, look, I don't know whether people should be getting advice from TikTok influencers and all that, but I'll say that dollar cost averaging itself as a strategy is essentially trying to buy a bunch of different prices for the same asset. So you might be buying a really diversified ETF and you're trying to get in at multiple points. And the logic behind it is quite simple. Is let's say you did have $100,000 to invest. You don't want to put it in and then tomorrow something happens, Trump announces tariffs are on again, and then the world blows up, right? And then now you've lost a really large part of that $100,000 you put in because you threw it in as a lump sum. The concept can be, maybe we spread that over 4 months or so, and we put $25,000 in each of these months. So, when you buy that first $25,000, something might happen, but that's okay. We still have $75,000 that we can sort of gradually put in there. And people don't necessarily realize this around super all the time, and they kind of think, well, I can also that this same rule applies to super as well, where people sort of go, well, I'm only going to make one contribution at the end of the year, and they might, be contributing a really large amount into the super, using up, their past contribution caps and everything. So they might go, I'm going to put $100,000 into my super close to 30th of June. But you do have to remember that $100,000 is also going to be invested into shares, right?
At that point in time.
At that point in time, exactly. And so, if the same thing happens as macroeconomic factors, which make your essentially the whole world sort of hesitate or lose confidence inside the share market, that $100,000 is going to go down a lot. And people sort of just look at, the nominal returns you said of super of 7 to 8% a year, and they don't realize, well, that is affected a lot by timing as well. So when you're talking about putting in lump sums, we want to be spreading that across multiple periods.
Yeah, so you average your entry price throughout the year rather than having exposure investing in just the 30th of June or just prior.
Exactly, yeah. So don't rush your super contributions is definitely the takeaway. But to your point as well, that's where salary sacrificing can be really useful. It's, essentially an arrangement between yourself and your employer, and they put X dollars every single month or every single fortnight, depending on your pay cycle, just into your super fund, and that buys in gradually. Automatically, you would be dollar cost averaging there.
But let's talk about the platforms that you use and offer to the clients. You could set someone up in a bit of a tailored portfolio with various, ETFs or whatnot that they're invested in, and can they contribute on a monthly basis and it's spread on that monthly basis into those various funds?
Yeah, absolutely. So, different platforms also allow you to have the flexibility. You can, put those funds in there voluntarily. You don't necessarily have to go through your employer either. And it sort of just hits that account and it gets invested pretty automatically in that way. And one of the advantages is when you put that contribution in, you can actually choose to, just make that a cash contribution, and then you can slowly buy in there as well. So if for people who are rushing and didn't realize by the 30th of June that they need to, put in X dollars, a lot of the time, sometimes what people can do is just change that to cash, and then they slowly buy back in as well. But one of the advantages, and again, sometimes people don't realize this, with salary sacrificing, you actually get that tax benefit immediately for each of the pay slips or pay cycle that you go through. You get an immediate tax benefit. Whereas if you personally contribute into super, you got to wait till you do your tax returns before you essentially see any tax benefit realized. And it's great and all because, when you do your tax returns, you might see a big refund, but at the same time, you would rather get that tax benefit immediately if you could, right?
So just to clarify what you said, someone could still make the contribution just before, 30th of June to make sure they get the concessional contribution cap met, but then just put it in cash in the super and then average out your entry prices with multiple transactions throughout the period after.
Yeah, absolutely.
So that's great advice, general advice.
Yeah, general advice.
So that sort of covers various investment pathways that people can consider when speaking to a financial planner. Like I said, superannuation, SMSFs, and then outside of super, all forms of advice and strategies to consider. I'd say the big other, almost 50% of the job description of a financial planner, risk insurance.
Yeah.
What's risk insurance?
Risk insurance is essentially trying to mitigate one of the biggest risks that you will have is your inability to essentially earn income in the future. I'd say that's how I define it. And I think people don't actually realize this, but one of the most important assets, especially for younger people or people in the accumulation, isn't the super or the property that they own. It's actually, what is the future income that they're expecting to derive? And just like you would get insurance for your home or your car, you want to protect these assets, right? And that's what risk insurance is really about, is how to protect your future income and your future earning ability.
I love that. That's really well said. It's so true. One of the biggest assets you actually own is your income and ability to earn that income. And I definitely have seen over the years people, not recognize and appreciate that when all of a sudden there's, change in their circumstances or also a change in their industry. And all of a sudden, they're unemployable or they're just not earning the same income.
Yeah, exactly.
Especially I've seen a lot of clients over the years where they sometimes are in, let's say, the tech sector, and their knowledge and skill set might become a little bit outdated. There's a lot of people being forced into retirement at an early age, and so there's ways to mitigate that risk essentially with insurance.
Exactly. Well, the idea of insurance is, if you are unable to work or unable to earn the income due to whatever reasons, or that's health reasons, or whether you need just to take a break from work, from burnout, there's just so many possible reasons that you can't continue to earn that level of income, and you want to protect it. And so that fundamentally is probably the most important insurance that you can have, is really how you're protecting your future assets. And I think most people think, when they think insurance, is just like death insurance, and that's like the death cover or life insurance is definitely one part of it, but that's definitely not the only cover that we're talking about here.
A lot of our messaging in our newsletters and whatnot, and we're hopefully going to be doing more of this moving forward, thanks to Roland. An important consideration when you purchase a new home, and you've got a young family with dependents that rely on the household income. As soon as you get yourself into that new family home, and there's a reliance on the income for not just the household, but for the family, as in not just the mortgage, but the actual family and living expenses, you should immediately then consider reviewing insurances to protect that household and protect those living arrangements. And it's something that people don't do enough. I think I read some data. It was actually in another podcast I listened to that 70% of Australians have suggested that they would like financial advice or speak to a financial planner, which includes discussing things like insurance, but only like 10 to 15% actually think that they can afford it. And things like risk insurance can actually be quite affordable.
Absolutely can be.
There's various ways to structure risk insurance. Some forms of it can come out of your superannuation, right?
Correct. Yeah. With your risk insurance itself, you can actually get it funded from whatever industry super fund that you have, and people don't realize this as well. Doesn't always have to be funded personally. Sometimes people think, well, it's going to cost me $500 a month out of pocket to fund this insurance. Well, potentially some of that could actually come from your super, and sometimes it's actually more tax effective to fund parts of it from your super, and obviously general in nature in terms of the advice. But depending on the type of insurance cover, some might be better owned personally, some might be better owned inside your super fund.
And once again, if you don't understand all these things, you need to speak to a financial planner to get your head around what suits your circumstances. And to call out, I guess, the individual circumstances. Don't feel that if you don't have the capacity to invest, then you shouldn't speak to a financial planner. You can still just speak to a financial planner purely for risk insurance purposes. You don't need to do a whole statement of advice and look at superannuation and investment strategies to then discuss risk insurance. They can just speak to you for purely risk insurance.
Exactly that. And it can be quite scary sometimes. I see clients who, just bought this really nice property, and they borrowed, like $2 million of debt, and they've used up all of their assets to fund this dream home that they have. But there's just nothing in place in terms of an insurance. And if tomorrow the worst happens, one of them is unable to work, or one of them goes there's some health issues which essentially makes them unable to work for 6 to 12 months, they don't have the ability to make those mortgage repayments without this insurance, and they're at risk of losing that home because they put everything into it, and they have this nice, wonderful place. But that's where this insurance is just so important to consider every single time.
Which is a growing problem at the moment. We're seeing household debt at all-time levels. And the average house price to income ratio is at all-time highs.
Yeah, that's right.
So people are really stretching themselves to buy a home. As you know, I got a phone call earlier today from the Sydney Morning Herald talking about the amount of pressure that people put on themselves to buy a home, and how far they'll stretch. But that's because people put such an emphasis on buying a home, and they look at it as an asset class, which is not a bad thing. I think it's good to put a significant amount of your overall income into housing, and it is a long-term good asset, especially with the capital gains tax exemption that you get. Excuse me. And then the second part of that strategy is protecting that home and asset, so the risk insurance does exactly that. So let's just call out quickly those types of insurance. You've got, how about I'll let you do it.
So you have your life cover. Your life cover gives essentially a death benefit, and this generally pays a pretty big lump sum for most people. The most important important aspect of this is for most people to protect that mortgage. So for people who have just entered into a really large mortgage, the question always comes up is, well, if tomorrow you or your spouse is essentially, does pass, well, what's going to happen to the house? Are you expecting your spouse to sell that, downsize, and move with the kids to a smaller place, right?
So the grim word for that is death cover. So you've got death cover.
You got death cover. You have total and permanent disability cover, or TPD cover, which essentially protects you, your spouse as well, if in the case that you're unable to work at any capacity in the future. There's a lot of definitions of TPD, though.
Yeah, I was just about to say, but people think you have to be quadriplegic or paralyzed to be disabled. It can just be, like you said, burnout. It can be. I've seen people claim it over health issues, mental health.
Exactly.
If they can't work and they're not functioning at work anymore because of mental health reasons, and there is a valid doctor's explanation.
Exactly. Yeah.
A true circumstance where someone can't work, then that's also covered.
Exactly. Yeah. So for some people, if you can't do the exact it's called an own occupation TPD cover, but if you can't do the exact role that you are trained to do and that you've gone through all these years of training to do, and that could be due to this multitude of reasons, such as mental health, or it could just be you physically do get hurt and you're unable to sort of continue in this role, then it will pay out on those definitions.
Which is crucial if you are in some form of job that requires you also to stand up and work on your 2 feet and use your 2 hands.
Yeah.
So obviously, labour is in construction, but naturally then the risk is priced accordingly.
Yeah.
For the insurance. It might be a bit more of a higher premium for something like that. But that insurance then pays until retirement, right?
Yeah, well, it'll provide a lump sum, essentially, which, could be a really significant amount as well. So just like, death cover where it gives you a lump sum, depending on how much you took out, total and permanent disability can provide a really big lump sum.
And then is it income protection that it can give you an annual salary until retirement?
Yeah, income protection is essentially, well, to me, I think it is one of the most important ones. It's the one which is even if you're temporarily unable to work, and that could be, again, due to mental health or whatever issue it is, that essentially helps replace your salary or a percentage of your salary so that you can, potentially still meet those mortgage repayments until you get back on your feet, or it can essentially help subsidize your living expenses until then.
So, and lastly, I think, something to call out with all those insurances. Did we cover them all? I think so, yes.
Trauma, that's the last one as well. But it is often the forgotten baby of insurance. Essentially, that one does pay a small lump sum if you're diagnosed with, some certain health conditions as well. That can be really useful once we talk about, well, if you do still want some level of help, if for example, your partner does suffer from, a heart attack or some sort of cancer, they still gives a bit of a lump sum, and that really helps with funding those costs of that too.
So lump sums and ongoings can be the form of, I guess, payouts. Other call out I was going to move on to next was how, you can get different types of insurance for different circumstances, and you can structure it in certain ways that you want. I believe it's opportunistic to look at these insurances at a younger age, just because it is based on your current bill of health.
It is, yeah.
So sometimes over time, and I've learnt this personally myself, you might have conversations with the doctor about things and you don't even realize that ends up being on your record.
That's right.
And then that is not insurable. So, the moment that you start having exposure to long-term health issues, then that unfortunately that makes those circumstances not something you can get cover on.
Yeah, it's exactly that. Like I've so many clients who, they want to do the right things. They go to the doctor, they check in, but from an insurer's perspective, that is additional risk to them, right? Because as soon as they get more information on this, you are deemed a high risk to them, and a lot of the time they might actually exclude certain things, or they might, put a higher premium cost because you've seen a doctor, which is the right thing to do, but the insurers need to price it accordingly. And so for a lot of potentially younger people who, you might not have as many health conditions earlier on, you get underwritten at the time that you enter that policy, and that can be really beneficial because at that point in time you might not have had all these health issues.
Or you were just young and didn't care about the potential long-term
health. That's it.
So just to call out that in a bit more detail, it's amazing how accidentally you can expose yourself to some of this bad news on your medical report. So I'll give an example that's quite common is just doing more detailed blood work, right? There's some people that genetically have certain exposure to long-term health risks. And as they, got a bit older now, when I say got a bit older, I'm talking in their 30s and 40s, not really that old, still relatively young. You've had some health concerns and you've done more detailed bloods, and then a GP or a specialist has said to you, hey, we've noticed in your blood work that you have a high risk of, developing XYZ disease. Well, guess what? XYZ disease is now not going to be on your insurance policy. So, it's really wise to look at these insurances sooner rather than later, especially also as we, sadly, and as grim as this may sound, as we grow old, we also deteriorate. So, we do start having more issues on our bill of health that can become uninsurable.
Absolutely. And I mean, I think one of the most common ones you see is actually to do with mental health. And to your point where, you might have just seen someone to speak about your mental health, and it could, have been like 1 or 2 years ago, but that's going to be a flag on your insurance record. And that's essentially it.
And it could be as simple as someone going through like a stressful time at work or in a divorce.
Yeah.
And they say that I'm anxious and I can't sleep. Well, then all of a sudden, no more cover under anxiety or mental health.
That's right. It unfortunately just is the way that insurance works. Is they need to price these risks, and to be able to essentially offer more competitive pricing for everyone else, they sort of just have to exclude these conditions.
Yeah, and like I said, it's really something to think about, because it isn't actually the role of the GP to make you aware of these things. So, sometimes I've seen some people get quite frustrated that they found out after being told something by a GP that they're now not insurable in that circumstance. And they're like, that GP should have bloody told me. It's not their job. It's not their role to say, hey, if we do this blood work, you might have an issue with your insurance.
Exactly that.
So that's not their job description. So speak to a financial planner about that type of concern. And lastly, just on that bill of health comment. So I believe it's still the case that you can get fixed pricing based on your current bill of health.
Yeah.
So what that means, do you want to maybe talk to that?
Yeah. So essentially to the point before that we mentioned as well, your pricing or your insurance premiums are going to be based off your current health conditions. So you're getting underwritten as you are today, and not necessarily in the past or in the future. It's genuinely, your health conditions as you are today. And so for most people, as we mentioned, for younger people in particular, it's much cheaper to get it today because, you are a lower risk. If let's say you're 20 something years old and you go through that process, they're underwriting you as a 20 something year old, and your risks are going to be underwritten as a 20 something year old. Whereas, when you try to get this 15 years down the track, you're probably going to be, let's say 40, you're going to be exposed to a whole new world of risks.
But if you've had that insurance in place until you're 40 or 50, let's just say, and then in your 40s or 50s, you find out you've got a heart condition or whatnot, it's not like your insurances go through the roof.
No, because you were underwritten when you were 25. So exactly that. Like, whatever does come up over those next 15 years, you were underwritten as you were 25. And that is actually one of the advantages of these retail insurance policies, is they underwrite you as of that date, as of who you are, and whatever happens afterwards, that's the point of the insurance, right? It's to protect you from those things.
All right. Well, I think that basically concludes today's session. We really summed up the role of a financial planner, as I kept wanting to allude to. There was some more points that I wanted to cover, but you know what? Like I touched on, we want to do more of this content moving forward. Our desire to educate our clients on the advice and role of a financial planner has been greater than ever. So Roland and potentially other planners in the team are going to feature more and more in our podcast to share insights, words of wisdom, and things we're seeing in the marketplace, and ways that you can sort of plan a comfortable retirement. So Roland, thanks for joining us today.
Thank you for having me.
And hopefully, if anyone wants to reach out, just hop on our website. You can see Roland's profile, or just inquire with info at Shaw, or give us a call and put you in touch with one of our planners.
Perfect. Thank you, Theo.
Thank you. All right. That was right on basically an hour pretty much.